If I had to start investing all over again today, knowing nothing except what 23 years inside finance taught me, this is exactly what I would do, step by step. Not a hot tip, not a get-rich-quick scheme, and not here is my secret portfolio. Just the plan I'd actually follow. And I'm going to do something most finance videos won't. Instead of asking you to trust my opinion, I'll show you the evidence behind each step. Because after 2 decades sitting on the other side of the table, the one thing I've learned is that in investing, the people who win are usually the ones who follow the boring evidence, not the loudest voice in the room. Quick context if you are new here. I am Ivan. I've spent 23 years in finance, most of it on the board and the credit committee of a development bank in Eastern Europe, where I personally appraised over 10,000 financing decisions. My whole job for years was to look past the story someone was selling and ask, what does the evidence actually say? That's the lens I'll use here, and my goal is simple: to explain this the way I'd explain it to a friend across the table. No jargon, no hype. Step 1 isn't the product. It is understanding why you are investing at all, because that's what keeps you steady later. Here is the honest case. Money sitting in a bank account doesn't stay still. Inflation quietly eats its buying power year after year, so cash slowly becomes worth less. Investing does 2 things instead. It protects your savings from that erosion, and over a long period, it grows them. And the real engine is compounding. Your returns start earning more returns. Historically, broad stock markets have returned somewhere around 7 to 9% a year on average. Over the long run, it's never a straight line, but the long run direction has been firmly up. I went deeper on the mindset behind all this in my 5 lessons video. I'll link it below. For now, investing is simply how ordinary money compounds into real wealth, slowly. Step 2 is where most beginners go wrong. When investing feels slow, it's really tempting to reach for something a little bit faster. Day trading, options, that hot crypto coin. I'll be blunt, from the inside, that is gambling, not investing. And on average, it is a loss. For most people, the fast lane ends in losses. But here is the part even careful people get wrong. They think the answer is just to pick good companies. The evidence says that's really brutally hard. Over the long run, more than half of individual stocks don't even beat safe government bonds. And a tiny handful of giant winners, around 4% of companies, created essentially all the market wealth above the safe baseline. The rest collectively just matched treasury bills. Finding those few needles in advance in a haystack of thousands, even professionals mostly can't do it reliably. So, where is the evidence-based answer? Don't try to find the winners. Own all of them. Buy a tiny slice of the whole market through an index fund, and you are guaranteed to hold every big winner, alongside the losers, but the winners more than carry the result. It's not exciting, it's just what the data has rewarded for decades. In fact, over the long run, the vast majority of professional, actively managed funds fail to beat their benchmark index, more than 80% over 20 years. And the longer the stretch, the worse it gets. In Europe, over the past decade, it's been around 9 in 10. Step 3. The vehicle. If you live in Europe, the way you own an index fund is usually through a UCITS ETF, the European regulated version. This matters, because most of the American advice you'll see online points you at funds you often can't even buy here, and the tax treatment is different. I'm not going to re-explain all of that now, because I made a whole video on exactly why European ETF investing works differently and what UCITS means. It's the natural next watch. I'll link it below. The short version for this roadmap in Europe, you want a low-cost, broadly diversified UCITS ETF. Step 4 is the question almost nobody asks themselves, and it's the most important one for safety. When will you actually need this money? Your timeline decides your plan. If you'll need the money soon, say within about 5 years for a house deposit or because retirement is close, then the priority is certainty, not growth. Keep it somewhere safe and stable, like a high-interest saving account or low-risk holdings, where a market drop can't force you to sell at the worst possible moment. But if you are investing for the long haul, 10 years or more, then you can afford to ride the stock market's ups and downs because time is on your side. And here is the evidence, first truth about those downs. Market declines are normal, not rare disasters. Since 1926, the market has risen in about 3 years out of every 4 and fallen in roughly 1 in 4. Down years are not the exception. They are the price of admission for long-term growth. The ability to sit through them without panic selling is what separates the investors who actually capture those returns from those who don't. That is also why step 4 pairs with one rule. Always keep a separate cash safety cushion. You never invest. A few months of expenses, so you are never forced to sell your investment in a crash to pay the bills. Step 5. Tax. Because what you keep matters as much as what you earn. In most of Europe, you'll face tax on dividends and on gains, and there are smart legal ways to reduce the drag. For example, accumulating ETFs can help with dividend tax in a lot of countries, and simply holding for the long term helps with the gains. But, and this is important, the rules generally differ country by country, and in a few places the usual advice flips. I went deeper on exactly this in my video on accumulating versus distributing ETFs, including how to find your own country's rules. That's the one to watch next if tax is your question. For this roadmap, just know, tax is a step you plan for, not an afterthought, and you check it for your own country. Step 6, and it's the one people put off for years. Actually, start. 3 small moves. First, open an account with a reputable, well-regulated broker. There are several solid low-cost options for European investors. The right one depends on your country, so check availability. Second, choose your broad index fund, and here you hit one real decision, which I'll only flag today because it deserves its own video. Roughly, there are 2 honest paths. One is a concentrated bet on the biggest market, think a major US index, which has delivered high returns in recent years, but carries more concentration risk in a handful of giant tech companies. The other is a global, all-world fund, more diversified, less dependent on any one country or sector, at the cost of perhaps a few points of recent return. Neither is simply right. And importantly, the very concentration that made the US win recently is also the risk you'd be taking on. Past performance doesn't come with a guarantee. I'm making a dedicated video on each of these 2 approaches, so I won't force a pick here. Third, once you've chosen, automate it. Set up a monthly contribution, buy, and then mostly leave it alone for years. That boring consistency, more than any clever move, is what actually builds the wealth. So, that's the whole roadmap. 1. Know why. Cash erodes. Investing compounds. 2. Don't gamble and don't stock pick. Own the whole market through an index fund. 3. In Europe, that is a low-cost UCITS ETF. 4. Match your plan to your timeline and keep a cash cushion. 5. Plan for tax and check your home country. 6. Open an account, pick your broad fund, automate and hold. None of it is flashy. All of it is what evidence has actually rewarded. And the necessary note, I'm not your financial advisor. This isn't personal advice, and nothing here accounts for your specific situation. Use it to think more clearly and to do your own homework, not as instructions. If you want to actually follow this roadmap, start with the videos I mentioned. They are in a playlist I'll link, built to watch in order. And if this gave you a clearer path than the usual hype, please hit the like button. It's one of the main signals YouTube uses to decide who else to show this video to. So it's the simplest way you can help another European investor find it. Subscribe if you'd like the rest as they come, including the 2 portfolio videos I promised. Tell me in the comments which step you're stuck on. I read every one. I'm Ivan. This is the Banker's Notes.